Alright, so today we're going to cover Chapter 3. And in Chapter 3, this is where we're really going to see the rubber meet the road. So hopefully you have put in the time in the first two chapters, you've established a solid base level of knowledge. Because here in Chapter 3 is where things start to get kind of wonky if you haven't developed that base understanding. So we want to make sure we've got a solid understanding on Chapters 1 and 2 before moving on. So hopefully you have that. And now we're going to jump right into Chapter 3. And as we go through, we'll kind of address the ideas and the topics one at a time. So the very first thing we want to look at in Chapter 3 is this idea of what is the accounting cycle. So the accounting cycle is really telling you, what are we going to be doing in this class? What do accountants do in general? How does this all work together? So we'll just kind of talk through this list really quickly, and then we'll move on to question number 2. So the very first thing that we have to do is we have to analyze transactions and events. So what this means is we're going to get together our receipts, our different information. We're going to see that something actually happened. We're going to start to think about how that's going to impact the financial statements, the company, how all these things are interrelated. The next thing we're going to do is we're going to actually journalize these transactions and events, and this is what we saw in Chapter 2, where we started performing our first journal entries in the semester. So these journal entries are the bulk of what we think of when we think of accounting. We think journal entries, journal entries, journal entries, and for good reason. Accountants make quite a few journal entries, so it's a good thing to be thinking about. The next thing that we're going to do is we're going to post this, and this means that we're going to actually post these accounts and these transactions to the general ledger or to the general journal. The next thing that we do is we prepare what is called an unadjusted trial balance. A trial balance simply lists accounts. So we've got all of our accounts here, and debits and credits, and it will list the debits and credits. And when you get to the bottom, you should notice that your total debits equals your total credits. And that's all that unadjusted trial balance is going to do. It's just going to give us that check really early on in the process to make sure we don't have any typos, we don't have any mistakes, everything looks to be working correctly. Now, a word of caution here, just because your unadjusted trial balance balances, meaning your debits equal your credits in total, that does not mean it is correct. You could have completely omitted a transaction, and because that transaction's been omitted, maybe your debits and credits in total still work, but they're actually the incorrect balances. So it does not guarantee that your work is proper, but it does make you feel that much better because you do have that early check. The next thing that you want to do is post your adjusting entries. Now, adjusting entries are the focus of Chapter 3, or one of the focuses in this chapter, and we'll see that. So what we're going to see is, over time, we might have to make an adjustment to an account or to a transaction. So things like, maybe you paid for rent a year in advance. Well, as each month goes by, you have now used up 1/12 of that rent, so you're going to actually make an adjusting entry to move 1/12 of that from that prepaid asset called prepaid rent to the expense account called rent expense. And we'll see that as we work through this chapter. Now, once you've done all of your adjusting entries, you will prepare the adjusted trial balance. Now, the adjusted trial balance will look very similarly to your unadjusted trial balance. It will still have a list of all the accounts. It will still list the total debits, the total credits, and it will still work down the same way. At the end, you should see your total debits do equal your total credits. Now, once you've prepared that adjusted trial balance, you are now ready to prepare the financial statements. Now, the financial statements we've talked about briefly in other chapters, but we want to hit on them again here. So, very quickly, what are our 4 financial statements and what order do we prepare them in? So the very first one that we see is what is called the income statement. At its most basic level, its most basic form, this is going to contain revenues and expenses. Now, over the course of the semester, we will add a few other things to that, but for now, just be aware, income statement, think revenues and expenses. So if you see the word revenue, 99% of the time, it's going on the income statement. If you see the word expense, 99% of the time, it is going on the income statement. There are some exceptions to those that we have to be careful with. Things like unearned revenue or prepaid expenses, these violate that. But for the most part, when you see the word revenue or the word expense, you will know that goes on the income statement. Now, the second financial statement we want to talk about is the statement of retained earnings. So the statement of retained earnings is going to take our beginning retained earnings balance, add in net income, back out any dividends, and then we will end up with our ending retained earnings balance. Now, of course, instead of adding net income, if you had a loss, you would subtract that net loss. And we'll prepare these financial statements several times throughout this assignment, so don't worry about that. We will actually see this in action later in the video. Now, the third financial statement that we want to prepare is called the balance sheet. Now, the balance sheet is described best by the accounting equation. So if you recall back in chapter 1, I told you if you were only going to learn one formula for this entire class, the one to learn is the accounting equation. And part of the reason it is so vital that you understand that formula is because it is the formula that describes our balance sheet. So we are told that assets equal liabilities plus stockholders' equity. So as we prepare the balance sheet later in this chapter again, we will actually see that equivalency between the assets and the liabilities and equity coming up. The very last financial statement that we prepare is what is called the statement of cash flows. Now, the statement of cash flows we will cover in extreme detail, probably more detail than you ever wanted, in chapter 12. So for now, we aren't going to really talk about it. I just need you to know it is there, it exists, we do prepare it, but you do not need to know how to prepare the statement of cash flows at this point in the semester. So at this time, we did have an acronym that we talked about before that was going to help us remember the order of preparation for the financial statements. And we said this was called I should be sleeping, which you probably all agree with at this point. So if you remember that you should be sleeping, or rather I should be sleeping, then you will remember the order of preparation for the financial statements. The only thing you have to be careful about, of course, is that there are two S's. So you have to make sure you know when the statement of retained earnings is prepared as opposed to the statement of cash flows. But as long as you understand that, then it will not be a problem for you. The very last thing that we want to talk about, or the second to last thing rather that we want to talk about here, is the idea of journalizing and posting closing entries. So these closing entries are the second main focus in Chapter 3. In Chapter 3, then, we are focusing in on not just preparing our regular journal entries that we saw in Chapter 2, where we prepared a litany of basic journal entries. In Chapter 3, we're going to actually crank up the dial a little bit and not only prepare basic journal entries, but we're going to prepare adjusting and closing journal entries as well. And so that's what we're going to focus on here in the third chapter. Now, the very last thing, of course, is to prepare the post-closing trial balance. And one of the main things you want to understand for the post-closing trial balance is that it will look quite different from your previous trial balances. And the reason for this is because your post-closing trial balance will only contain what we call permanent accounts. Now, at this time in this video, that may not make a lot of sense to you, it may not provide a lot of value, but we will dig into what it means to be a permanent account now so that you can make this make some more sense. So, what we want to know first is there going to be another acronym that's going to help me understand what we are going to be closing, what we're going to be leaving permanent? And the answer is yes, of course there is. anytime we can come up with an acronym to help you understand this stuff, we're absolutely going to do that. So the next acronym that we want to look at is what we call CRED PALS. So this will be CREDPALS. So what this is telling me is the accounts in the term CRED are the accounts we will close. The accounts in the acronym PALS are the permanent accounts. So those accounts will not be closed. Let's see if we can figure out what we notice might be some similarities in these items. So the accounts we're going to close, can you think of an account that you would maybe want to get rid of at the end of each period? This starts with the letter R. Just a broad grouping. Well, when I think, the very first thing I think of is revenues. And in fact, revenues is the correct answer. So we're going to close our revenue account at the end of each period. So if we know we're closing revenues, what's the related account to revenue that we might also want to get rid of? And of course, that will be expenses. So we will close revenues and expenses. These two items are found on the income statement. And we will also close dividends. Now, quick question for you. Are dividends found on the income statement? And if you recall from previous chapters, what we said was dividends, in fact, are not found on the income statement. And you say, well, why not? They reduce equity the same way that an expense does. And you're almost right. They do, in fact, reduce equity. But because when someone buys a share of stock, we do not send that to a revenue account. When we give them their money back, it cannot go to an expense account. It would violate the matching principle. For that reason, dividends, in fact, do not show up on the income statement. So you say, well, where on earth do they show up? Well, dividends show up in two places. On the statement of retained earnings and the statement of cash flows. Of course, assuming we're talking about a cash dividend. This is a stock dividend. The procedure is slightly different, but that is beyond the scope of Chapter 3. So at this point in time, just do be aware, dividends do in fact go on the financial statements, but they do not go on the income statement. Very good then. So now we have talked about the accounts we want to close. Now what are our permanent accounts? So can you think of something that might start with the letter A that we really want to keep around for a long time? And I'm hoping what you just said is assets. Of course, our assets we don't want to get rid of at the end of each period. So these assets are going to persist from period to period. Now, what else might need to persist? This starts with an L. Well, that's going to be our liabilities. So our liabilities will stick around with us, and so will our stockholders' equity. So that tells me, if I'm really thinking about this, my temporary accounts that are going to be closed, so my temporary accounts, are more or less my income statement. And my permanent accounts are my balance sheet. Now, of course, this breaks down slightly with dividends because dividends aren't on the income statement. But broadly speaking, we close the income statement and the balance sheet remains permanent. So what does this tell me? How does this make sense? Why are we doing this? What is the purpose? Right? These may be questions you're asking, and they're great questions. So here's what we want to think about. That income statement is telling me for this year, for this period of time, whether it's a month, a quarter, or a year, here's how we did operationally. Here's how much revenue I brought in. Here's how much in expense I had. Here's all of this information relating to that one specific time period. But it goes away as soon as you start the next period. Because if I want to know how many sales I made in 2020, it doesn't matter to me how many sales I made in 2019. I might want to look for comparison. I might want to look at ratio analysis. I might want to look at trend analysis. All that's wonderful, but I can't even do that if I'm just building on top of last year's numbers. So I eliminate all of last year's numbers through this closing process that we're going to get to in a minute, reset all those revenue and expense accounts back down to zero at the end of the year, so that at the beginning of the next year, I've got a nice clean set of books ready to begin all over again. Now, you say, well, why can't we do that with the balance sheet? And the reason is because if you did that with the balance sheet, what you're saying is that December 31st, assuming you have a regular fiscal year, that's just January 1st to December 31st, what that would do is at the end of the year, you would be giving away all of your cash, all of your equipment, and someone else would be picking up all of your liabilities, and your company would be gone. For all intents and purposes, you would have nothing. It doesn't really work. And if you think about it, it makes sense that it doesn't work, because just because the year changes, the cash in your bank account doesn't poof away. It doesn't reset to zero. You still have that cash in that bank account. You still own all that equipment. So all of your assets stick around. Now let's think about this and see if that works for our liabilities. And what would happen if that didn't work for our liabilities and we instead closed our liability accounts? So say you had someone come out and do some work for you on December the 30th. You tell them, all right, this year December the 30th is on Friday. I'll pay you on Monday. Well, Monday is January. Now we're into the next year. So if you were closing those liability accounts, by the time Monday rolls around, you would not show a liability for them at all. They would not get paid. They're probably not going to be very happy. You're probably not going to be able to get them to come back out and do any more work for you. It creates all these issues. So liabilities also persist past what we call the closing date, which in this class will typically be December the 31st. Now, let's think about the stockholders' equity section. A stockholders' equity is also going to persist from period to period, as it's showing us how much the owners have actually invested, either through the form of buying that interest through common stock or through the profits from day-to-day operations on the income statement. So when all that information on the income statement gets done with and done away with at the end of the period, it has to go somewhere permanent. We need a way to track that year-over-year income and loss from the business. And the way that's going to happen is we're going to move that temporary information that was held in these revenue and expense accounts and even in these dividend accounts. We're going to move all of that to the balance sheet through the closing process by using the account retained earnings. And we'll see that all flow through. And so that brings us to the end of question number 1. And hopefully it gives you a pretty good overview of exactly what's going to be happening here in chapter 3. So chapter 3 has got a lot of meat to it, but it's also one of my favorite chapters. It's a lot of fun to go through here and really see the pieces begin coming together. So, the very first thing we're going to do here is prepare our adjusting entries. Now, to prepare our adjusting entries, what we want to make sure we understand is there is one very simple rule that we want to go over right at the beginning. So hopefully you've been really paying attention in those first 2 chapters as we went over what went on the income statement and what went on the balance sheet, because that's going to help us here. So the adjusting rules we've got a couple. So the very first rule I want to go over is you must have at least one income statement account. And the second rule is at least one balance sheet account. The third rule is the same as always, in that total debits must equal total credits. And the fourth rule, no cash. You will never use the cash account in an adjusting entry, because the cash has either been paid or received at a prior date or will be dealt with at another time. So you will not actually see that cash account in any of these entries. So let's go through these, see if we can figure out how to record these journal entries. So it tells us here in letter A, wages of $11,000 are earned by workers but are not paid as of December the 31st. So imagine with me really quickly. Let's say these wages were for the period of December 25th through December 31st. Over this period, we owe our workers $11,000. Because we owe them that $11,000, they have actually done the work for us in this period. Since the work was done in that period, the expense must be incurred in that period because all the work they did was to help us generate revenue for that week or for that month, whatever the case is. So that expense must go in that same fiscal year. So how do we do this? Well, we have to take that $11,000 and put it directly to this expense account. So we've got this expense. We're saying, yes, we realize we owe you that money. We did incur that in that period. So we're going to debit wages expense, which will increase the expense and thereby reduce overall equity. Now, we have debited the expense. Let's check our rule. We used an income statement account. Check. Have we used a balance sheet account yet? No, we have not. So I know immediately, because I know that wages expense goes on the income statement, the account I'm looking for must go on the balance sheet. So I can immediately eliminate any other revenue or expense accounts from my journal entry when I'm thinking through what this account could be. Well, the pairing here is going to go to wages payable. So just like we had wages expense saying, yes, we recognize this was an expense in this period, we also have the payable. Now, what type of account is the payable? It is a liability. And where do liabilities go? They go on the balance sheet. So we see this liability increasing in value, and we see the expense also increasing in value. So you say, well, how on earth does that keep the accounting equation in balance? Well, you're looking at this, you say assets equal liabilities plus equity. The liability has gone up by 11 plus a minus 11 to equity. So this comes out to be a zero change, and assets did not change. So overall, the accounting equation has remained in balance and the world is good. So that's all that's happening here. Now, in the very next one, it tells us depreciation on the company's equipment for the year is $10,600. Now, we've not talked about depreciation up to this point in the semester very much, if at all, but we will actually go through how to calculate depreciation later in the semester. Just at this point in time, we're just going to tell you depreciation is an adjusting entry. Please show me how that would be recorded. If you take the time to learn this now, when we hit depreciation in a couple of chapters, it'll be that much easier for you then. So what we want to see here is the idea of what is depreciation. And depreciation is really just the systematic devaluation of an asset over time. So there's a couple of key components here. The first is that it is systematic, meaning there is an actual equation behind this. There's actual mathematics. There are actual rules for how we come up with these numbers. We don't just decide to write an asset down by a certain amount. So the second piece here is that this is a devaluation, which will lower the carrying value of that asset over time. So what we want to see here is that this depreciation expense is our income statement account, because it is in fact an expense that is going up, which will reduce equity. We then want to make sure that we understand the other side of this, which is our balance sheet account. That is accumulated depreciation. And in this case, this is our first contra account. So accumulated depreciation is what we call a contra asset. What this means is that it will pair with the related asset on the balance sheet. So you have your balance sheet, you will have assets, you will have equipment, then you will have accumulated depreciation dash equipment, which will work to reduce the value of that overall equipment account. It means it pairs with that equipment account on the face of the balance sheet, but works against the overall balance by reducing it. So we see that this is bringing assets down. So equity has gone down, assets have gone down, the accounting equation remains in balance, and the world is once again good. So that brings us to the end of part number 2 of this question, and we will move on to the third. So in the third part of this question, in letter C, we are told that the office supplies account had a $410 debit balance at the beginning of the year. During the year, $4,689 worth of office supplies are purchased. A physical count of supplies shows $519 of supplies are available. So, the easiest way to solve a question like this, and I'm just going to erase all this down here at the bottom just so we can use the room. Those rules will still apply, of course, through the rest of what we're doing. So we'll just kind of verbally check those as we go. But I need the space for now. So what we're going to do is we're going to draw us out a T account, just like we saw in an earlier chapter. And we're going to call this office supplies. So now we're just going to put in all the information they've given us. So they told us here, they said, the office supplies account had a $410 debit balance at the beginning of the year. So I'm just going to put in $410 right there. Now it tells me during the year, we purchased $4,689 worth of office supplies. A physical count shows only $519 worth of office supplies left at the end of the period. So what we want to know essentially is how much in office supplies was actually used during the period. So what we know is we started with 410. We added 4,689, and that's going to give me a subtotal. Whatever that is, then I'm going to back out the 519 that's left, and that will give me the amount of my expense. So this is one way to solve this, or you can use the T account method, which is often a lot more intuitive. So what you're doing here is you're saying, I'm going to add everything on this side and subtract everything on the other side. So in this case, what I need to find out is if I had 410 at the beginning, I purchased 4689, and I'm left with 519, how much was used? So to do that, take your 410 plus your 4689, subtract the 519 that is left, and you'll see that you must have used $4,580 worth of supplies. So now when you look at your journal entry, in this case, it might actually make sense to just start with the credit, because when you use the T account method, you see your credit right here. It's just a credit to office supplies, or in this case, they just use the supplies account. That's all right. For $4,580. That's exactly what we see right there. So now you say, well, what on earth is the debit? So if you think about the supplies account, the supplies or the office supplies account is an asset account. And which financial statement do assets go on? Well, assets are going to go on the balance sheet. And if you remember our rules for adjusting entries, we said a couple of things must be true. We must have at least one income statement account, at least one balance sheet account, total debits and total credits must be equal, and we can never use the cash account. So, in this case, we have already taken care of my balance sheet account, which is supplies. So supplies is an asset. Assets go on the balance sheet, and in this case, the asset is going down because it has been used. So supplies expense is an expense account, and expenses go on the income statement, and that is going up. That expense is going up because an expense is a normal balance of a debit. Now, how is that keeping the accounting equation in balance? Well, if you were to look at it, you would see assets equals liabilities plus stockholders' equity. That expense is going to reduce your stockholders' equity. And the asset supplies is coming down. Of course, both these are by the 4580, so your equation will remain in balance. So that is how we're going to tackle that third piece of this question. Now for the fourth piece, it tells us here, the prepaid insurance account had a $5,000 balance at the beginning of the year. So Basically, we're going to do the same thing we did on the last question. Just going to erase all of this so we can plug in the new information. So instead of office supplies, in this case, it will be prepaid insurance. Now, the prepaid insurance account is, of course, an asset, and it tells us we had a $5,000 beginning balance at the beginning of the year. An analysis of insurance policies shows $2,100 worth of unexpired insurance benefits remain. So our ending balance is $2,100. So if I didn't have any more prepaid insurance during the year, and all I've been doing is using up portions of this, then what I need is to figure out how much we used during the year. So how do you go from $5,000 down to $2,100? You use $2,900 worth of prepaid insurance. So that tells me right away in my journal entry, my credit will be for $2,900 to the prepaid insurance account, which we see right here. Now, what type of account is prepaid insurance? Prepaid insurance is an asset. Assets go on the balance sheet, and since it is being credited, the asset balance is declining. Now, what we need to think of next is that handles the portion of my rules that say we must have a balance sheet account. But what about the income statement account? So just like how we had a supplies expense account for supplies, we're going to have an insurance expense account for our insurance. And so we see that here. Now, that insurance expense is, of course, an expense account. Expenses go on the income statement, and that expense is increasing because it is being debited. Now, don't think that expense being debited is a good thing or a bad thing. It just is, right? That expense is increasing because it has been debited. So the next piece here, we see the company has earned but not recorded $550 worth of interest revenue for the year ended December 31st. So we got $550 in interest revenue. The interest payment will be received 10 days after year end on January the 10th. So the question is, have we earned this revenue? Do we need to book it in this period, or do we defer it until the next period? Hopefully, you said we need to go ahead and book that now, because it told us here, and it's very important that you see this phrasing, the company has earned but not recorded $550 worth of interest revenue for the year ended. So we're told we have earned this. Once we have earned it, we can book it. So in this case, we have actually earned the revenue. So this revenue is related to interest. So we do have an interest revenue account. That is going to, of course, be a revenue type account, which goes on the income statement and is increasing because it is being credited. And we said earlier in the semester that revenues increase with a credit, as that is their normal balance. The next thing we need to figure out is, now we have booked the income statement portion of this journal entry, we need the balance sheet portion. So you say, well, what goes on the balance sheet? Well, assets, liabilities, and equities all go on the balance sheet. So I'm going to need to pull in this interest receivable account right here. And that, of course, is an asset. And assets go on the balance sheet. And that asset is increasing since it has been debited. So that tells me everything I need for that question. So for number 5, it's just a debit to interest receivable, which is our asset account, and a credit to interest revenue, which is that revenue piece of the transaction, or that income statement portion. Now the last section here says the company has a bank loan and has incurred but not recorded interest expense of $2,500 for the year ended December the 31st. The payment will occur 5 days after year end on January the 5th. So just like the last question, you have to ask, do I need to record this in this period, or will I wait to record this expense until the next period? Now, if you could, you would like to wait to record this expense because you would then have less expense showing on your income statement. Your company would look more profitable. Your retained earnings would be bumped. All these wonderful things happen. But the question is it proper to delay that expense recognition until the next period? And in this case, it is not. And the reason is because they told us, just like in letter E, the company has incurred but not recorded. So we have actually incurred this expense in this period because of the matching principle, because of the framework of accounting. It says we must record that expense in the period it is incurred. So we're going to go ahead and do that now. So the way we're going to record that is with a debit to interest expense, which is showing us that expense in this period. So that is, of course, an expense. Expenses go on the income statement, and that expense is increasing. Now, on the other side of this, you say, well, if we haven't paid it yet, has any cash left the company? No cash is left, and that's because we won't pay this until January the 5th. So what we've got to figure out is, how do we show that we owe somebody money at the end of the year that we haven't yet paid? And that's what we talked about in chapters 1 and 2, as this idea of a liability, or this idea of, more specifically, a payable. And that payable tells us, yes, we owe you money. We recognize that. We fully intend to pay you. We're just going to book it for now so that later we don't forget. And that's really what we're doing here. And so that keys in our investors, hey, look, we've got this interest payment coming up, and they know to expect that coming out in the next period. So we see that interest payable there. That is a liability. Liabilities go on the balance sheet, and that is, of course, increasing. And that is because a liability has a normal balance of a credit, and in this case, we are increasing the amount of money we owe them for that loan or for that interest payment. And so that wraps up the end of question number 2. And so with that, we will move on to question number 3. So in question number 3, we're going to be preparing more journal entries. In this case, it is just, once again, more adjusting entries. So we'll go through this one a little bit quicker. I'll just jot the rules down here at the bottom, talk through them very quickly, and then we'll move on to number 4. So we said the very first rule was at least one income statement account. And I strongly recommend you write these along with me, because the more you write it and the more you say it, the more you will remember it. Then you need at least one balance sheet account. You need total debits to equal total credits. And finally, no cash. Never, ever, ever, ever tell me in an adjusting entry we are going to use the cash account. We simply are not. So if you think, oh, I need to use the cash account in this adjusting entry, then it's not an adjusting entry. Or if you do put it there, it will automatically make the journal entry incorrect, because cash will never show up in an adjusting entry. It just won't happen. It can't happen because of the rules and everything, how it all works. So just be aware of that. So don't make that mistake. I see it all the time. People get in a hurry. They get rushed. They feel like they're running out of time on an exam or a quiz, and they throw in the cash account. Often the cash account is a great guess, but when you're making those adjusting and those closing entries, stay away from it. Stay away from it. Okay? Now, in this question, it tells us here, depreciation on the company's wind turbine equipment for the year is $5,200. You'll notice this is the exact same journal entry that we had on the last question when we had depreciation. The only difference is those numbers have changed. From now until forever in this class, the journal entry to record depreciation is always a debit to depreciation expense with a dash telling us what that's on. Is that equipment? Is that on a truck? Is that on an oil well or an oil rig? What is it on? And then the credit will go to the associated accumulated depreciation account. And that's it. So if you learn that entry now, when we talk about depreciation in several chapters, you'll already know that journal entry. And it'll just be one less thing you've got to learn now or at that time. Now, in the second piece of this question, it tells us here, the prepaid insurance account for solar panels had a $2,200 debit balance at December 31st before adjusting for the cost of any expired coverage. Analysis shows $700 of unexpired insurance remains at year end. So, here we've got our prepaid insurance. Our beginning balance was $2,200. It tells me at the end of the year we had $700 of unexpired coverage. So this is my ending. So how much was used? 1,500. So if I take 2,200 minus my 1,500, then I will see that what is left is, of course, this $700 in my ending balance. So for my journal entry, I will need to use my $1,500. So I will debit my insurance expense account, which is an expense. Expenses, of course, go on the income statement and is increasing in this case. And my credit is to the prepaid insurance account, which is an asset. Assets go on the balance sheet, and my asset is declining because we are crediting the asset. So that wraps up letter B, or part number 2 of this question. Now for the next one here, we're told the company received $3,600 in cash in advance for sustainability accounting work. As of December 31st, 1/3 of the sustainability accounting work had been performed. So in this case, let's just take this one a little bit more slowly because we got some more moving pieces here, some accounts we haven't seen in a while. So in this case, we are told we received $3,600 in advance. So when we received that $3,600, did we have revenue at that time? I hope some alarm bells are going off in your head and you're saying absolutely not, because that is the correct answer here. What did you have when they gave you that cash in advance of you performing services? At that time, you actually create a liability. And you say, whoa, 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 why on earth would that be a liability? Because they gave me money, right? I'm going to do the work, and you might very well intend to do the work. But what if for some reason you are unable to do the work? Then you have to actually return that money. So they still have a claim on those funds until you complete the work. So in fact, on the date they paid you, the journal entry to be recorded is going to look like this. It would be a debit to cash. Sorry, that's a little messy right there, so we'll fix that. A debit to cash for $3,600 and a credit to the unearned revenue account for $3,600. Now, cash, of course, is an asset and it is increasing. And unearned revenue is a liability and it is increasing. You'll notice in this journal entry, I'm using the cash account. But this whole video, I've been saying, don't use cash, don't use cash, don't use cash. And you say, well, didn't you just break your own rule? No. And the reason is this right here in this box is not an adjusting entry. This is just a regular, plain Jane journal entry. You can use cash all day long in those. It's the adjusting entries where we are not allowed to use the cash account. So now we come along. At the end of the year, we've actually earned some of this revenue. So what needs to happen is that unearned revenue account needs to come down, which is exactly what we're seeing by debiting that account. And that consulting revenue account needs to increase. And that's exactly what we see here. So let's check all of our rules. Unearned revenue, what type of account is that? That is a liability. Liabilities go on the balance sheet, and the liability is decreasing because it is being debited. And the flip side of this is our consulting revenue. That is, of course, a revenue account. It goes on the income statement and is increasing. Now, I want you to be very, very careful here because earlier in this video, I told you almost every time you see the word revenue, it will go as a revenue account on the income statement. I said every once in a while, that is not the case. And we have found that exception. And that exception is here with unearned revenue. So unearned revenue definitely has the word revenue. It's right there. The problem is the unearned portion. Because it is unearned, it is not a revenue. It is instead a liability. So be very, very careful with that account. That's one of the most common mistakes I see when I give you a list of accounts and I'll say, what type of account is this? Which financial statement does it go on? Very often, people will flip that one around. So take your time. Make sure you understand if it is unearned, it is a liability. Very good. So moving on to the next piece here, it tells us as of December the 31st, $1,400 in wages expense had been incurred but not yet paid. So once again, wages expense is an expense account. Expenses go on the income statement, and that is increasing. Next, we take our credit to the wages payable account. This is a liability that goes on the balance sheet and is also increasing since that payable is being credited. Now, the very last piece here, it tells us as of December 31st, we have earned, but not yet recorded, $420 of interest revenue from investments in socially responsible bonds. The interest revenue is expected to be received on January the 12th. So they're asking me, what journal entry do we need to record at the end of this period as of December the 31st? So I have interest receivable, which is an asset. Assets go on the balance sheet, and since that asset is being debited, it is increasing. My credit then is to interest revenue. That is, of course, a revenue account that goes on the income statement and is also increasing. So now we'll just very quickly go down and check all of our rules. So on the very first one, we have depreciation expense. Of course, that is an expense. It goes on the income statement, is increasing. Accumulated depreciation is actually what we call, I'm going to abbreviate here, a contra asset. So CA goes on the balance sheet, and it is actually also increasing. But that will actually reduce the value of the asset, which is how you're going to keep that accounting equation in balance. So we've got an income statement account. We've got a balance sheet account. Debits equal credits, and there is no cash. This journal entry looks good. Here we've got an income statement account, a balance sheet account, debits equal credits, and no cash. Here we've got balance sheet account, income statement account, debits equal credits, no cash. We're looking good to me. Next, wages expense, income statement, wages payable balance sheet, $1,400 to $1,400, no cash account in sight, looking good there. And finally, balance sheet, income statement, $420, no cash account, that one looks good. So we've satisfied all four of these rules in every one of these journal entries. And if you take the time to actually analyze your work and make sure you have followed these rules, you should not have a problem with any adjusting entry I give you throughout the entire semester. You should be able to figure them out and make sure you have at least given yourself the chance of having that journal entry correct by not doing something silly like giving me 2 income statement accounts or 2 balance sheet accounts or something along those lines, or using the cash account when it's forbidden. Those types of things are very easy mistakes to avoid, but they're very, very common because people get in a hurry and they rush and they don't take the time to fully understand these rules and how to use them to your benefit. So make sure you do that, and you should have no problems. Now here in question 4, we're going to actually start by preparing our financial statements from a trial balance. So this is the trial balance they have given us, and they're telling us basically pull any information you need out of here for each financial statement. So very quickly we'll run through this. Hopefully it'll make some sense, and we'll get on to question number 5. So I do want to point out one thing really quickly. Notice there are some blank lines here. There may be 1, there may be 3 blank, there may be no blank. There's no way to know how many will be blank on an exam. I will most likely give you additional lines, though, to make sure you understand exactly what goes where and you're not just filling everything in. That's not to say that once in a while it could take every line. You know, it absolutely could. So you've just got to really know your stuff, know where everything falls, and you should not have too much of a problem. So very quickly then, when we're preparing our income statement, which is our first financial statement, we said we need revenues and expenses. And those are the items we're looking for. So as we look through our accounts, do you see any revenue accounts? The very first one that sticks out to me is services revenue. And in fact, that is the only revenue in this case. So what we're going to do is I'm just going to highlight my revenue in green. So services revenue right there. Easy enough. And we're done with the income portion of my income statement. Now I'm going to use this orange color because the red's a little bit harsh on this screen. So I'll use orange for my expenses. So here, I now need to find all of my expenses. So let's just look through this and see what the first one we come across is. So I'm just going to follow this in order just to make the video easier to follow. But they're actually a little bit out of order to to the trial balance. If you gave it to me on an exam in the order of the trial balance, that's totally fine. If you gave it to me in this order, that's fine. I'll figure it out. Just make sure you get the right numbers associated with the right accounts and you don't forget something. It's the only reason I would normally try to go just in the order of the trial balance, just to make sure you don't forget an account or get one in there twice or do something silly. But in this case, I'll just follow the order they have provided. So the very first thing we see here is depreciation expense on the buildings for $12,000. And we see right here depreciation expense on the buildings for $12,000. The next one that they show us here is wages expense for $9,500. So we have wages expense for $9,500. Interest expense for $900. Interest expense for $900. Utilities expense $3,300. Utilities expense $3,300 right there. Next we have supplies expense for $600. And we'll just need to find that right here. Supplies expense $600. And finally insurance expense for $3,800 is right there. Now, very quickly, I do want to point one thing out. I'll just use this purple for it. Dividends. Why do we not see dividends down here? Hopefully you can answer that question on your own. And the answer is because dividends are not an expense. Okay, this is something I have tried to talk about many times in these first few videos because it is so important, and it is one of the most common mistakes I see is people trying to tell me dividends are an expense. Dividends, in fact, are not an expense. They're simply a direct reduction of equity. And we'll see that by looking at our statement of retained earnings on the next page. But in this case, all we need to do to finish this up now is I will take my $120,000 in total revenue, back out my total expenses of $30,100, which is just the sum of all of these items here. And that will give me my total net income of $89,900. Now, really quickly, I just want to show you why you have to prepare the income statement first. And it's because that $89,900 actually flows down into your statement of retained earnings. So you see that connection, which is why you have to do the income statement before the statement of retained earnings, or you would not have the information you need to complete it. Now, this question tells me that the retained earnings account balance was $118,800 on December 31st of the prior year. So my beginning retained earnings balance is that $118,800, because if that was my ending balance at the end of December 31st, it is also my starting balance at the beginning of January of the next year on January the 1st. So that just pulls straight through. Then I add in my net income that we just calculated on my income statement. That gives me this subtotal here of $208,700. I then back my dividends out, but you notice that happens on the statement of retained earnings, not on the income statement. So there comes out my dividends, and then the netting of this $208,700 and my $13,000 will give me $195,700, as you see right there. And so that tells me my ending retained earnings balance. And you say, well, that's all well and wonderful. Why on earth could I not just skip this whole thing and go straight to my balance sheet? Because that's the one we really want to see, is that income statement and that balance sheet. Why do I need to stop and do the statement of retained earnings? Well, here's where this gets really interesting, because just as the net income pulled through from that income statement, your retained earnings balance is going to pull through into your balance sheet right there. And there you go. So if you had not done your statement of retained earnings, the number you would have pulled through would have been this $118,800, and you would have noticed when you finished, your balance sheet would not have balanced. And you would have been pulling your hair out saying, oh my gosh, what is going on? Why does this not work? I did everything right. And you very well might have, but since you skipped that middle step, your retained earnings balance would be wrong. So make sure you go through this procedure and actually go through all the steps, and you'll make sure you don't have any silly mistakes. Now here, all we're doing is we're going to prepare a basic balance sheet. You will notice this is not a classified balance sheet. We're still preparing an unclassified balance sheet in this question. So all of our assets are simply lumped together. All of our liabilities and all of our equity is all just lumped into broad categories. We don't have the finer divisions that we'll see later in the semester. So for my assets, I'm going to go back to my green. So the very first one that we see is cash for $50,000, and sure enough, there's my cash account. Then we have accounts receivable for $8,000. So now I just need to find over here accounts receivable, $8,000. Supplies, $1,800. So now I need to find my supplies account for $1,800, and there it is right there. Next, I have prepaid insurance for $4,500. So I will now pull through that prepaid insurance account for $4,500. And here's where it gets a little bit tricky if you don't really know what you're doing. Okay, so it's with this buildings account. So the first thing I've got to do is find that buildings account. There it is for $240,000. But because that is not the end, there's actually one more step. So because this is not a brand new building that we bought on the last day of the year, there is some depreciation associated with this. So the question is, how much? So, quick question. Do I need to pull the $12,000 depreciation expense or the $35,000 accumulated depreciation? And that's a good question. So let's think. What are we trying to do on the balance sheet? On the balance sheet, I'm trying to track the valuation of this asset over time. So I'm going to need the accumulated depreciation balance of $35,000, not the $12,000 of depreciation expense. So we pull through that $35,000, and that $35,000 drops right here. I'm sorry, I got the pencil and not the highlighter. So the $35,000 goes right here, giving us a net balance for that asset, or a net book value, which is the appropriate term, of $205,000. Now, when I take my 50 plus my 8, plus my 1,800, plus my 4,500, plus 240 minus 35, I will come out to total assets of $269,300. Now, the next thing we need to look at is my liabilities. So for my liabilities, once again, going to use this orange color. So I need to find all the liabilities that we have. So I see accounts payable for $11,500. I see notes payable for $31,000. I see wages payable, and that is, of course, for my $2,400, which we have right there. Then I have interest payable for $900, and we see interest payable right here for $900. And finally, we have the unearned revenue account, and that unearned revenue account is for $1,800. Now, you will notice that my liabilities are only $47,600, while my assets are $269,300. Is there a problem here? Or is that okay? Well, let's continue, and we'll see if we can figure out why it might be that my assets don't equal the liabilities. So, as we continue, we said, well, now we need to do our equity accounts. For equity, I'm going to use this purple color. So the very first thing we need to see is my common stock. My common stock account then is this $26,000 that we see right here. And now the question is, well, where does this retained earnings number come from? And that, of course, is what we hinted at earlier, which is it comes from our statement of retained earnings, and is this right here. This ending number that we calculate there becomes the number we use in my balance sheet right here. And so you see that connection, and you hopefully see why the balance sheet has to be prepared after the statement of retained earnings. So now you see total equity, which is the sum of these two items here, is this $221,700. You then also see the liabilities of $47,600, and hopefully that light bulb's going off and you're saying, oh my gosh, there it is. The sum of the $47,600 and the $221 is the $269,300, which ties back to your total assets. So if you recall, since chapter 1, we have said assets equal liabilities plus stockholders' equity. Earlier in this video, I told you this was essentially the formula for the balance sheet, and you see that happening here. Assets is in fact equal to liabilities plus your equity. And there you have it. You've got a nice balance sheet done. You've tied down your assets to your liabilities and equity, and you feel pretty good about this. Now you notice there's quite a few accounts on here we did not use for this balance sheet, and those are used either for the income statement, the statement of retained earnings, or possibly the statement of cash flows. But in this case, it's just going to be the income statement and the statement of retained earnings if it's not used on the balance sheet. So that wraps up question number 4 for us, all 3 parts, and now we will move on to question number 5. So in this case, we are told that the following adjusted trial balance contains the accounts and year-end balances of Cruise Company as of 12/31. They want us to prepare the closing entries for them, assuming the income summary account is number 901. So here is why it is so important that you understand your normal balances. When you close an account, you must do the opposite of what you would normally do. So wait, what do you mean? So, if you would normally increase an expense account with a debit, to close that expense account, you must credit the expense account. If you would normally increase a revenue account with a credit, then you must debit the revenue account to close it. So we will see that happen in this question, and in this textbook, and in most introductory textbooks, they run this through what is called the income summary account. That is perfectly fine. You can shortcut this in an upper level class by taking everything straight to retained earnings, but in this class you will be required to use the income summary account. So make sure you do that. And you don't find another textbook, maybe someone you know has taken intermediate accounting, they're showing you how to do this. Tell them, we realize you can do it without the income summary account, but in this class, the income summary account is appropriate. So we want to make sure we do use that account. So let's see how we're going to do this. So very quickly, we talked earlier in this video about the acronym CredPals. And we said we will close revenues, expenses, and dividends. We said these 2 items are on the income statement. This is the statement of retained earnings and cash flows. 2 separate financial statements, right? Statement of retained earnings is prepared after the income statement, before the balance sheet, and a statement of cash flows is prepared after the balance sheet. There is not a combined statement of retained earnings and cash flows. I simply did that to save space. Please don't let it confuse you. The next thing that we needed to talk about then were what accounts do not get closed, and we said, well, that is our assets, liabilities, and stock holders' equity. So, in this case, the accounts that are part of the income statement will go to the income summary account. So, hopefully that is easy enough to remember. If it is part of the income statement, it will go through income summary. If it is not part of the income statement, it will not go through income summary. So, please do keep that straight as well. So, what we want to see here then is as we go through this, we will identify which accounts need to be closed and which accounts are okay to not be closed. So the very first thing we see here is this service revenue account for $40,700. Well, that is a revenue account, and since it is a revenue account, it will need to be closed. So normally you would credit a revenue account. So to close it, you will debit the service revenue account. That is, of course, a revenue type account that goes on the income statement, and it is going down because you are debiting that account. Now, the income summary account, I'm not really going to say what type of account it is. I'm just going to call it a temporary account. While it is true that your revenues, expenses, and dividends are also temporary accounts, the income summary is like the absolute definition of a temporary account. It is only there while we do our closing entries. As soon as we're done closing, that temporary account, the income summary account, vanishes again. You'll never actually see it on your financial statements anywhere. So I'm not going to really dig into what type of account it is, where does it go, because it doesn't really go anywhere. It's just there to help us close these accounts out. So in this case, we have debited service revenue to eliminate all of that and put it back down to zero. And we have credited the income summary account for $40,700. Now, the very next thing we need to do then is get rid of all of our expenses. To do this, the easiest way is to just skip the first line and list out all of your credits, and then go back up there and figure out how much needs to go to that income summary, because it's really what we like to call a plug figure in accounting. If you talk to too many people in accounting for very long, you'll find out we don't really like using the word plug, but that's exactly what this is. So we're just going to call it a plug figure. So this right here is a plug amount because there's a bunch of stuff going into this. There's no way to get that without doing a little bit of math. So the very first thing we're going to do is eliminate our depreciation expense. Then we'll get rid of our salaries expense, our insurance expense, our rent expense, and finally supplies expense. When we do all of that, all of these will now be credited because they're all expense accounts. Expense accounts typically increase with a debit. So to reset these accounts and bring them all back down to zero to begin for the next period, what we will need to do then is credit those accounts. So we credit all of our expense accounts. We then add up all of these. Whatever that comes out to will then be the amount that we use for the debit to income summary. Now to figure out the next entry, once we have closed our revenues and our expenses, we then must close income summary. So if you were to draw out a T account for the income summary, what you would see is $40,700 as a credit, $31,507 as a debit, which would leave you with $9,193 as a credit balance. If it has a credit balance, then you will need to debit the income summary account to remove it. So now this is going down to zero. Retained earnings is now going up. So retained earnings has increased by the amount of our net income, which is at $9,193. And we have now officially closed all of our revenues, our expenses, and our income summary account. So you say, well, that sounds great, but what was the point of that? Why does it matter? And the truth is, what's happening here is we are moving this information from the income statement to the balance sheet through the retained earnings account. So this retained earnings account is the vehicle in which we're moving this temporary information that was found on the income statement to the balance sheet. So we're actually able to get that link where we keep up with the year-to-year information on the income statement for that period, but we recognize that year-to-year information is very important over the life of the company. We don't want to just destroy that information, so we bring that along to the next period through the balance sheet, and that's the vehicle we're using to do that. Is that retained earnings account. It's a very powerful account for us. It's very helpful. Now, the very last thing we need to do is get rid of these dividends. So we look and we see our dividends here of $6,000. Normally, you will debit the dividends to increase them. So we will credit dividends to take them down to zero. And you will debit retained earnings, which will also reduce the retained earnings balance. So you've now zeroed out those dividends. That dividends account is ready to go to record the next year's dividends that are paid. And we have that first piece out the door, and we're done with question number 5. Now for requirement number 2, they ask us to prepare the post-closing trial balance. Note the retained earnings balance was $40,600 on December 31st of the prior year. So $40,600 plus the $9,193 minus the $6,000 should give you this $43,793 that you see right there. Now, the next thing we want to look at is this, was my adjusted trial balance. It had all of these accounts on it. But if you look at what we end up preparing for my post-closing trial balance, what do you notice that's missing? We've got cash, supplies, prepaid insurance, equipment, accumulated depreciation, common stock, retained earnings. What financial statement do all of those items go on? They all go on the balance sheet. So the question you should be asking then is this. So wait a minute. Are there not any income statement accounts on a post-closing trial balance? And that's absolutely correct. Because the income statement accounts all got closed during the closing process. And we're not going to include all these zeros on a post-closing trial balance. So simply all that's there is your balance sheet accounts. And so that's exactly what we see. We see cash, which is an asset, supplies, which is an asset, prepaid insurance, another asset, equipment, asset. Accumulated depreciation dash equipment is a contra asset. Common stock is equity, and retained earnings is equity. So there's no temporary accounts on that post-closing trial balance, and that's because they've all been cleared out in the prior period. At this point, it's just a matter of finding the balances up here that you need for each account, dropping those in, and making the previously stated adjustments to that retained earnings account. What you should then find is that your total debits once again equal your total credits, and we have once again proven that fundamental fact of accounting, that total debits always, always, always need to equal total credits. Now, for number 6, what they have told us here is they want us to prepare the income statement for 12/31, and they want us to prepare a statement of retained earnings. I'm really going to just kind of talk through this one quite quickly. I'm not going to show all the links because this is exactly what we've done in previous questions. So just feel free to go back, look through this one as you wish, but it's not worth us devoting a bunch of time here when we've already done this question previously. So what we see here then is for our revenues, we just want to find those revenues up in this table here. We will then locate that, drops in right there. We then need all of our expense accounts coming in. Those will then be totaled up to equal 111,787, which will be subtracted from that revenue of 147, which gives you total net income of 35,713. That 35,713 will then pull down into your statement of retained earnings. Your beginning retained earnings balance is given here as 136. You'll then back out your dividends that were paid, which were listed in the facts of the question, and then that will give you your ending retained earnings balance. So there's the dividends right there that you'll use, and that gives you the final piece of question number 6. Now for question number 7, they want us to prepare a classified balance sheet. So this is the first one of these we've actually prepared this semester, but from this point on, this is the most likely option of what I will ask you to prepare. It is the more well done version of the balance sheet. This type of balance sheet provides much more useful information to decision makers, and therefore is what we prefer to see as accountants and as managers in the field. So this is what we will expect from this point on, unless specifically told not to do this. Just assume classified is what we want. So what's the difference? Well, if you notice, there are a couple of differences right off the bat, and it's these broad categories: current assets, plant assets, current liabilities, long-term liabilities. And with each of these, you also get a new subtotal: total current assets, total plant assets, total current liabilities, total long-term liabilities if there was more than one, total liabilities. Now you'll notice there's not a current and non-current portion of equity, because equity by definition is not current or non-current, it just is equity. So what we need to do then is figure out which assets are current and which assets are long-term, and then which liabilities are current and which liabilities are long-term. Now, technically speaking, there is a certain order these current assets should be listed in. And the way you're going to remember this order is with this acronym. Can she really invent something practical? Now, this is just the acronym I was taught, and I think it's fantastic. It's always helped me. It's the one I always come back to when I'm trying to properly order a current asset section of a balance sheet. So I strongly recommend you familiarize yourself with it and you get comfortable with it because it's very, very useful. And it helps you identify very quickly, oh, okay, those are all my current assets and the other stuff is probably long term. While this is not a perfect list, it's pretty good. And it gives you the kind of general flow of how this will work. So the very first asset that you should always list in your current asset section is cash. How much do you have in cash? The next is your short-term investments. So this might be like if you're a day trader, you buy something for 28 cents now and 3 minutes later you sell it for 31 cents and you pocket the 3 cents. And you do that all day long, right? If you do that all day long, maybe you come out pretty good by the end of the day. I don't know. But, you're managing maybe 100 trades at a time. You've got all this going on. You can make some decent money like that. Those are short-term investments. They're rapidly trading. They're basically as fluid as cash. The next thing you've got are your receivables. And while I say this list is not inclusive, it's because of stuff like an allowance account that will go with receivables later. It's not specifically listed in this acronym, but hopefully once you recognize that the receivable is there, you'll eventually be well enough that you recognize that contra account, that allowance for people not paying us, is going to pair up nicely with that as well. Now, what's slightly less liquid than a receivable? Well, that's going to be your inventory. So your inventory is going to be the stuff that you have sitting on your shelf ready to sell to clients or to customers, to the public, whoever your client base is. That's your inventory. Why is it less liquid than a receivable? You still have to sell it. Next is supplies. So supplies you could sell if you absolutely had to. You could take the ink out of your printers at work. You could sell your mouses and your keyboards, and you could sell all that. Hopefully you don't, because it's probably a sign you're going bankrupt. But you could sell that stuff if you absolutely had to. And finally, you got your prepaid expenses. And these prepaid expenses are going to be the idea of prepaid rent, prepaid insurance, prepaid utilities, whatever you're prepaying. And that you could get your money back on it. You could, but it's going to be pretty difficult. Because once you've prepaid those bills, they don't really want to give your money back. If you fight them hard enough, you could probably get it back, but it's going to be a bit of a headache, so it's very illiquid. And the idea of liquidity says, well, how fast can this item be turned into cash? And so that's the order that this is. This is in the order of decreasing liquidity. So we start with the most liquid, which is cash. How long does it take for cash to become cash? No time at all. It's already cash. A short-term investment you can sell very quickly in an online marketplace or over the counter. Then you've got receivables. Those you can collect or you can factor those, as we'll talk later in the semester. And you sell those receivables to someone else to collect cash now. You've got your inventory, your supplies, your prepaids. All those are current assets that we expect to be used up within the next 12 months. And those and that is the order that we'll show those in. So all we're going to do now is come up here, find all those current assets in this little block right here. They will drop right there, and we've got our total current asset line. Boom. Next, what we want to look at then is our long-term assets. Well, trucks and the accumulated depreciation associated with those trucks are definitely long-term assets. We hope those persist and help us for more than 12 months. And land is, of course, a long-term asset. Now, what did we say the distinction or the big issue was with land earlier in the semester? You cannot depreciate land. So you must make sure the land is accounted for separately from any buildings or equipment put on top of the land. The land must be separate. So that land is, of course, a long-term asset still, but it cannot be depreciated. So now you've got your total current assets of $24,000, your total plan assets of $173,000, which gives you total assets of just under $197,000. Now, as we move down the list, we'll then need to do the same type of analysis for my liabilities. Now, we don't have a nice acronym like, can she really invent something practical for our liabilities? Because there's just no telling what items you're going to see for liabilities. So here you just got to really think about it. Is this going to be done within 12 months or not? So in this case, accounts payable, right? You go down to the store, you buy 1,000 reams of paper for the university, and you say, that's fantastic. I'll pay you on the university credit card at the beginning of next month. That's accounts payable. That will definitely be cleared within the next 12 months. So we see that accounts payable balance coming through in this current liability section. The next thing is very similar. It's interest payable. Of course, that interest will need to be paid promptly. We can't delay the interest payment for over a year. So we know that has to be a current liability. As we look through the accounts in that trial balance, what we notice then is those are the only current liabilities, and the rest of the liabilities are in fact long-term. In this case, they were actually nice. They only gave us one liability, and they actually told us that it was a long-term notes payable, which tells you it's going to go in that long-term section of the balance sheet. Now you take your total current liabilities of 21, your total long-term liabilities of 50, which gives you total liabilities of $71,100. Now, before you even do the next section, you could jump and know what that number is, because if you know assets equal liabilities plus stockholders' equity, and you know you've done everything else right, you know assets are approximately 197, your liabilities are approximately 71, so you know this is going to be about 126, and you see that is roughly what that comes to right there. So you can already have a good idea of what that bottom line number should be, as long as you have done everything else properly to this point in the question. Now, what you're then going to do down here is you just got to pull out those equity accounts. The very first one that you see then is the common stock account. And in this case, they tell us that the common stock account was $839. Now let's see here. They actually show it right there, negative 839. So you're just going to pull that through right there. Next, retained earnings is 125,677. So 125,677 is going to be our total equity. The way we're going to get that, so what we need to do then is some math out to the side. I paused the video for just a second to get this jotted down, just to speed up the video for you a little bit. So what we're going to do then is we're just going to come in, find our beginning retained earnings balance, and what we're essentially doing is a mock income statement / statement of retained earnings, where we just pull out all the numbers we need just to get that number down at the bottom. It's not as clean as if we were to prepare an actual income statement and statement of retained earnings, but it'll get us the numbers we need. So once we come in and we find this beginning retained earnings number here of 136, we will then add in our $127,000 worth of trucking fees that were earned, back out all of our expenses here, and our dividends last. Once all of that is done and the math is put into a calculator, you will come out to 126,516 for your ending retained earnings balance. So that ending retained earnings balance will then drop right here, which will give you that total equity number of 125,677. Now, once you come in and you take that total equity of 125,677, add it to total liabilities of 71,1, it'll come down to 196,777 for total liabilities and equity, which of course matches my total asset number that we have right here, which once again proves the equality of the accounting equation, so we know we have done this properly. So good work on number 7. We'll move on to number 8. Now number 8, what we're looking at here is our profit margin. So how do you calculate profit margin? Well, profit margin is going to be calculated as net income divided by net sales. And that is equal to my profit margin. So I'll take 5,280 divided by 46,730, 88,586 over 416, and on down the list we will run. So as you do that, you will calculate the profit margin for each. And looking at this, what we see then, the question says, which is most profitable according to profit margin? Well, the one with the greatest profit margin ratio is, of course, the most profitable, and that looks to be Company C, with a 35% profit margin. So what does this tell us? This tells us that Company C not only has the highest profit margin, but that they actually earn 35.3 cents in net income for every dollar in sales they make. This is incredibly efficient. They maybe don't have very much overhead, or they've got a very cheap product to make, or maybe they're very good at making it. Whatever the case is, they're able to generate a lot of profit very, very quickly. Now, a company like Company D, they're just barely making any money on every sale. So for every dollar in sales Company D makes, they only earn 3.8 cents in net income. Now, for number 9, it tells us here we want to calculate the current ratio. So current ratio is going to equal current assets divided by current liabilities. So in this case, what we'll do is we'll take the 83,000 over 42,784. That'll give me this number, and we'll do that all the way down the line. Once we finish doing all of those calculations, the question then asks us which company has the strongest liquidity position, i.e. which company has the highest current ratio. So out of those options, we see 1.94, 1.07, 0.7, 1.8, 1.47. Of course, 1.94 is the greatest, which tells us that Edison has the highest current ratio. Now the question is, can your current ratio be too high? And the answer, of course, is yes. So one of the problems with having a current ratio be too large is that you may have tied up all of your assets into current assets that are not as productive as a different long-term asset. So you want to make sure you're not keeping too much in those current assets where you could be making better investments over a longer time horizon. That is perfectly fine. In this case, I would say maybe they are a bit high. Assuming these are all in the same industry, it looks like the rest of them are hovering close to a 1, and they're almost at a 2. So it looks like they could actually be having a bit of this problem, or maybe they've stacked up way too much inventory and they can't get it to sell quickly enough. So they've got all this inventory sitting on shelves, incurring carrying costs and all these different problems, but we don't know that. It's not necessarily a bad thing to have a high current ratio, but if it gets too high, it could absolutely be a problem. At the same time, if it gets too low, that could be a problem as well. So you want to make sure you kind of manage that based on the industry, and you stay around what your competitors are at. So now for question number 10, once again, they have us preparing an income statement, statement of retained earnings, and balance sheet. So I'm not going to go through this one as detailed as we have on the others because it's essentially the same thing. A couple of quick things to point out here. Really, this is just a longer version of the previous questions. In this case, you actually do have 2 revenue accounts, both fees earned and interest earned. That gives you your total revenue. You then have to find all of your expense accounts listed in this table up here. Once you found all those expense accounts, they simply drop one after another, giving you a total expense number of 434, which gives you net income of 158,400. You'll notice that 158,400 then falls through as the addition for net income in your statement of retained earnings. Your beginning retained earnings balance was 266,220. That drops right there. You then back out the dividends that we have for this year of $55,000 right there. And that gives you the ending retained earnings balance of $369,620. That $369,620 then will fall into this bottom piece right there. And the rest of these accounts simply pull from the table above. So we'll look at a couple of them really quickly just so you can see that happening. So $239 for cash, $50,000 for accounts receivable, and sure enough, you see those all coming in right there. Do be careful on a couple of these, like the automobiles and the equipment. Those should both have associated contra accounts. For the automobiles, it is accumulated depreciation - automobiles, and for the equipment, it is of course accumulated depreciation - equipment. Then once you have totaled all of your assets up, you will see that your total assets is equal to $772,200. You'll then do the same thing for your liabilities. Once all of those have come down, you will get a total liability number of $373,000. You will then simply need to pull the common stock number that was given to you of $29,580 in the table above with your retained earnings balance that comes from the prior question, or the prior part of this question rather. Once you then add those total liabilities and your total equity, you will see that the total liabilities and equity equal to your total assets, once again proving the accounting equation to be correct, and once again emphasizing why it is so important that you do understand that equation. So once again, there's this link right there. And that wraps up the Chapter 3 homework. So hopefully you found this video helpful. Of course, if you have any questions, always do feel free to reach out to me. I'm always happy to get back with you as quickly as I can, try to help you understand this stuff. I know Chapter 3 has a lot of moving pieces, and that's why I really hope you took the time to nail down those first 2 chapters, because Chapter 3, while it's a lot of fun getting to see how all of this connects and getting to see how all this works together, if you haven't done that groundwork prior to Chapter 3, it's very easy to get lost very, very quickly in Chapter 3. So I hope this helped you. I hope you had as much fun with this as can be expected with an accounting assignment, and we will see you in Chapter 4. Thank you so much.